Good afternoon, and welcome to the React Group PLC results for the year ending September 2022 investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll. I would now like to hand you over to CEO Sean Doak. Good afternoon to you.
Thank you, Alex. Thank you, and thanks for everyone joining us today. So we've got myself, Sean Doak, I'm CEO of the group. We've got Andrea Pankhurst, our CFO of the group, and we've got Mark Brawns, our Executive Chair on the call as well. So let's just start off by doing a deeper dive into what the group is all about, and we'll have a look at the overview, please, Alex. Thank you very much. Okay, so React Group carry out specialist contract cleaning, where ultimately we're focused on non-discretionary requirements. We're UK-wide, typically looking after complex demands over a nationwide fulfillment criteria. The business or the group now is we've got three elements of the business. Strategy is focused on building out long-term contracted work, both organically and through selected M&A. And the recurring nature of the business will give us a more predictable model moving forward. As I said, we've got three segments. So we've got the commercial window and cladding cleaning to begin with. That's generally regular recurring revenue. So typically cleans can be carried out daily, weekly, or monthly at worst. Typically high margin, typically north of 40%. Long-term commitments from the clients and incredibly sticky customers. That work is predominantly carried out by the Ladders Free business, which is the business that we recently acquired back in May of 22. Next, we've got the hygiene and maintenance division, and that is delivered through the Fidelis business, which is based in Birmingham. Very strong within the school, university, and industrial space. Again, recurring revenue. Typical commitments from the clients are 3, 5, and 7-year commitments. And then last but not least, we've got the emergency and decontamination side, which is carried out through the React Specialist Cleaning division. That business is typically split into three segments. The first segment being contract maintenance, which is a little bit like, for an example, a deep clean at a hospital. So we're on site all year round, and we also do a lot in that space in the rail sector, just ensuring that the carriages have a deep clean and they return to the quality and the standards that they once were when they left the manufacturing plants. Next, we've got the contract reactive, which is framework agreements, work with a number of clients within the judiciary sector. And that can be anything from a dirty protest all the way through to a bodily fluid clean of either a transportation vehicle or a prison cell. And then the final segment to that business is the ad hoc project defined work. So something like a fly tip, high level clean, and so on and so forth. So look, on the back of COVID-19, cleanliness and hygiene is clearly ranked much higher in social conscience, and that's raised the demand for a more consistent and reliable solution provider, someone capable of delivering anywhere in the UK, and that is very much in the React Group wheelhouse across all three of the businesses. We believe there's scope to continue what is a significant expansion in what is a sizable and fragmented specialist cleaning market. So just moving on to the customers, please, Alex. Okay, so this will be a new one for you because we're not really put any customer logos up on this platform before. But we work with a number of blue chips, a number of tier 1 customers, and some large FM management companies here in the UK. Clearly, we operate across a very diverse range of market sectors, and typically they're resilient markets where the requirements for our services is non-discretionary. So it just gives you just a handful there of logos of some of the customers we work with. And if we actually look at material spend customers, we've taken it from 12 months prior to this point, from 238 to 350 as we stand today, but we've actually got across the board over 1,000 customers. It's the 350 that are material spend customers. So I'm going to pass you over now to Andrea. She'll give you an overview of the performance summary and then the segmental analysis.
Okay, thank you, Sean. So the graphs that you can see on the screen are showing our progress over the last 5 financial years. Obviously, I'm going to focus on our most recent figures for up to September 22, so our FY22. So year on year, FY22 compared to FY21, our revenue is up 78% and our gross profit is up 38%. So the reasons for those increases are, there's a mixture of reasons. One of them is clearly the acquisition of Ladders Free, and also the fact that last year in FY21, we just had 6 months of Fidelis's results in there, whereas now we have 12 months. But aside from that, on a like-for-like basis, we have got underlying organic growth across the group of 17%. So that's all those statistics combined, all those impacts are the reason for the changes year on year. Our average gross margin has decreased from just over 30% to just over 23%. The reason for this is, again, not a simple one. There's lots of factors here, but the main one really is that the mix of work that's in the business in FY22. So with a full year of Fidelis, with its long-term contracts, those contracts come with lower margins. So the mix of having a full year of those lower margins has impacted the average group margin. Ladders Free, as Sean has previously said, is a higher margin business. This time next year, when there's a full year of Ladders Free there, I will anticipate that average margin will be going back up again. We've previously stated that our sort of target group margin is in the high 20s or low 30%, and I think that still holds true. That's what we're aiming for. Our EBITDA for the year was £1 million, just under £1 million, and that was what we were expecting to do. So we're pleased with that figure. So I think the only other point I want to make at this on this slide really is that a stated strategy of ours previously has been to increase our proportion of recurring revenue. Our recurring revenue proportion at the end of FY22 was 83%, and it's a bit higher now already during FY23. It's now higher than 85%. And we're happy with that level, and that's really where we anticipate it staying. Could we move on to the next slide, please? Okay, thank you. So we've previously talked about the different segments that we report how we report our figures, and Sean has already referred to these. So contract maintenance. These are regular contracts. We have contracts that last 6 months. We have some contracts that last up to 7 years. So that revenue is predictable. We know it's coming in over a certain time scale, and that type of revenue is what we've been working hard to increase. So by the acquisition of Fidelis and Ladders Free, as well as organic growth within the existing business, you can see that's the biggest increase on those bar graphs. Secondly, our contract reactive work. This is where we have framework agreements, where we get called out to customers to provide a defined set of services at defined prices. This work is less predictable because we never know how often we're going to get called out, but we've been doing it for quite a long time. So we we do know there's a pattern, and we do keep getting called out. This work, it did soften during the end of FY21 and the beginning of FY22. This is partly because customers really weren't spending so much on anything discretionary post-COVID. And so there was less demand for a while. During the second half of FY22, that demand has picked back up again. And you can see year on year, there's a slight increase there. Ad hoc work. So last year or the year before, when we were doing this presentation, we were talking a lot about COVID. COVID was generating at that time a lot of our ad hoc work. Obviously, that COVID-related work no longer exists. But as you can see, we've held our own in the ad hoc segment. We've replaced that COVID work with alternate work, and demand is still strong in ad hoc as well. So I think that's all I've got to say on the figures, and I'll hand you back to Sean.
Cheers, Andrea. Thank you. Just moving on to the year that was really 2022. We've had good organic revenue growth, which has clearly been augmented by the successful acquisition of Ladders Free. We've had some strong sales performance, a number of contract wins there, once again demonstrate and React Group's organic growth credentials. As Andrea said earlier, we've had some strong growth in the contract maintenance business, which has improved the mix. And our long-term recurring revenue run rate now is just north of 85%, which is fantastic. The reactive services, Andrea touched on it earlier. You know, we did have some challenges and a slowdown during the first 9 months of this year, and that has begun to rebalance. We've seen that return to normal levels. And combine that with the success of winning the longer-term Fidelis contract, it did create a temporary downward pressure on the margins, but they will rebalance, and they are beginning to trend upwards, which is again great. The acquisition, the integration of Ladders Free, it's gone fantastic. Great team, small team, headed up by Jason and Justin Koroneg, who are the founders. Very entrepreneurial guys, still involved in the business as consultants, working very well with the rest of the group. The team's, very excited and very much engaged with what, the future has in store and the ways in which we want to grow the business. And early signs of cross-selling, we've had success there. You would have seen the post-period announcement of the multi-year contract worth 800,000, and that was for 350 locations for a well-known fast food outlet here in the UK. So just moving on, please, Alex, to the next slide. Thank you very much. So just on strategy, we've stood here before for a few years, and we've mapped out the key components of our strategy, and that is to become the leading specialist cleaner business here in the UK. We based it a year ago, our strategy that is, on 4 key components. That was to scale through organic growth and selected acquisitions. We wanted to strengthen our relationships with customers and cross-sell. The third was to focus on markets where the React Group have clear differentiation and access to higher margins. And the fourth part of it was to strengthen the recurring revenue streams through incremental long-term contracts. Now, in the blue there, just on the slide, you'll see the milestones that we've achieved throughout 2022. 78% growth, 17% organic. We hired 2 senior salespeople into the business. Chris Ryan joined to head up the Fidelis business as sales manager. And we brought in Sam Hayward, who now heads up the sales team across group as group sales director. They've made a material impact to the business since joining. We've had multiple contract wins, and we've grown the recurring revenue streams as we said earlier on in the presentation. With regard to strengthening relationships, we've continued to expand the business that we do with a number of tier ones and our FM businesses. Taxi Rail being one of them. We've got new sites online, and that's a mix of the 3 segments. We're doing a lot more with the FM businesses, and the contract that we secured back in 21 of April that continues to have an upward trend in the work that we're securing with that business. Extra care, prime example. We've taken the spends and multiplied that by 5, basically. Where we are today at a run rate. So proof is in the pudding that we can do that. With regards to recurring revenue, we've increased the recurring revenue. We appreciate that the margins need more work, as we mentioned earlier. With regards to the Ladders Free acquisition, we see it as very much being transformational. We've got clear differentiation there, access to high margins, incredibly sticky customers, and a really motivated team. And then last but not least, we've grown the recurring revenue from circa 83% to an exit run rate now of north of 85%. So that's what we've achieved throughout the year, and that was against our strategy. Just moving on, please, to the acquisition slide, Alex. Thank you. So just to summarise Ladders Free, so they were established in 2002. They are one of the UK's largest nationwide commercial window cleaning businesses. They are highly profitable, they're cash generating, recurring revenues, and low working capital. They've got a very competitive ecosystem of over 300 local service member partners. And I don't want you to think that they are mom and pop shop partners. They are, in some instances, they have a fleet of 5 or 10 vans themselves. So they are very professional, they're trained, audited, certified in exactly the same way as they would be if they were employed directly. And obviously, high quality focus and rigorous safety standards included in there. As I said earlier on in the presentation, the customers are very sticky, attracted by the quality and the performance and the low cost, especially on multi-location and nationwide customers. They've grown the business prior to acquisition through very modest marketing, and the strategy very much evolves around applying the group's sales and marketing capability, and that will continue to drive the strong organic growth in what is a unique, high value, high margin and cash generative business. And just before I move on from that slide, if you just look at the customer segmentation, it gives you an overview really of those customers. I just want to, if you look at the churn is 0%. They've not lost any national customers in 5 or 6 years, and the same for the regional facilities management businesses. And the nationals and the FM are perfect sectors that we've done so well with React Specialist Cleaning and Fidelis as we've grown the business. So it's right in our sweet spot to really grow the Ladders Free business. So just moving on to group outlook, please. So we've had a strong finish to the year end in September 22. We've got momentum continuing into this year. As I said, the emergency reactive business is returning to strength, and the long-term contracts won and mobilised by Fidelis last financial year are now delivering revenue as expected. The Ladders Free acquisition expected to continue making a material and growing contribution to the group's performance. The integration couldn't have gone any better. Like I said, values, work culture, and dedication very much aligned to the rest of the group. And revenues and margins have been strong since we completed the acquisition in May 22. And then just to wrap things up on summary, please, on the next slide, Alex. Thank you. We remain strategically focused on building out the long-term recurring revenue streams in the non-discretionary specialist markets, as I said earlier. We've got a track record of delivering double-digit organic growth alongside strategically important acquisitions. And we believe, the Ladders Free acquisition is not just transformational, it's earnings enhancing as well. So we believe, in summary, that we're well placed to build scale in both market cap and earnings. Thank you.
Sean and Andrea, thank you very much indeed for your presentation this afternoon. And if I may, I will just bring your cameras back on. Ladies and gentlemen, please continue to submit your questions using the Q&A tab situated on the top right corner of your screen. While the company take a few moments to review those questions submitted today, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via our investor dashboard. Sean, Andrea and Mark, as you can see, we have received a number of questions throughout today's presentation. And thank you to investors for submitting their questions. Mark, if I could just hand over to you to go through the Q&A tab, read out the questions and give responses where appropriate to do so, and I'll pick up from you at the end. Thank you.
That's lovely. Thank you very much, Alex, and thank you to those of you who've submitted questions. So as we've done before, I'll just sort of coordinate it to give Sean and Andrea the opportunity to think what their answers are. We have 5 pre-submitted questions. Unfortunately, I don't have the names of the people that submitted them, so forgive me for not mentioning them. The first one here is, I'll read it. With Ladders Free joining the React group last year, can you explain how the cross-selling works? Is there a team specifically doing this? At this early stage, have there been any significant results in cross-selling? Sean.
Okay, brilliant. Thank you, Mark. Yeah, so I guess there's 2 elements in play here. There's the strategic and there's the tactical. So tactically, we have had results already. The material contract that we announced post period is a prime example. And there's a lot of smaller contract wins that we've had underneath that haven't been announceable. £50,000 to a retail outlet, furniture retail outlet is a prime example that we recently secured. Margins typically north of 40%. From a strategic point of view, we just need to take a step back here and build out, a map for what that longer term piece looks like.
Yeah, indeed. Thank you, Sean. So, often I see companies and sales leaders, and I'm a salesperson myself, talking about cross-selling being, key to things, and then you never see it happen. But I think it is worth commenting briefly, Sean. This is not just about Ladders Free. We've done it when we acquired Fidelis as well. I mean, I guess situations like Extracare was a prime example where, a customer of Fidelis was spending about a couple $100,000 a year, and you combined together as a group, you managed to arrive at £1 million a year contract for 5 years. That's the kind of nature of how we operate, isn't it, in terms of cross-selling?
Yeah, very much so. And like I said earlier, Mark, they're the larger opportunities. There's a lot of smaller opportunities that we've not been able to announce. That just highlights the cross-selling across group. I think the sales team we have a very tight sales team. We have the weekly marketing calls where we pivot and we change our strategy on a weekly basis. That works very well. So we can change tact as and when we need to. We know what works. We know that, prime example, on the marketing call last week, the cadence of emails that we sent out and followed up, we had a call to action rate of around about 68%, which is just unheard of in that kind of arena. So, we're getting that right. We're setting things up, and all credit to the sales team. They're, securing contracts. So everything's going well in that department.
Brilliant. Next question is for you as well, Sean. We announced back in 21 a significant contract with a very large FM business. And the question, I'm paraphrasing actually, the question is the company in all the FM sites yet? Are they satisfied with the service? So effectively, how are we progressing with that particular agreement?
Yeah, so good question. It's progressing well. There were some challenges, and we shared those challenges prior. We just had to hold the customers' toes to the fire to unpick the incumbent relationships. You've got, in some instances, relationships there that have been there for 10, 12 years. And it was our customers' systems that initially were letting them down. They have made changes to that. I'm personally engaging with the category manager there on a regular basis. We have a quarterly face-to-face meeting and, a monthly call. And that, an upward trend there. There's still work to do. But we're working in unison together, i.e. us and the customer, to make sure that spend filters through.
Brilliant, thank you. Next one, another pre-submitted question. Andrea, and Sean, you might want to comment on this. It says, accepting that profit margins are financially sensitive information, can React indicate whether the profit margin for the company will be higher or lower for full year ending September 2023 than the full year 22 of 23.8%? You're on mute, Andrea.
Apologies about that. Yeah, I think I've probably covered this point already. It's I think with the higher margin ladders free with a full year next year in the figures, I anticipate that margin going back up, and we've got a goal of having an average group margin of around about high 20s, 30%. I'm hoping that we'll be close or achieving that sort of level this time next year.
Brilliant. I think it's also true to say that recovery on the reactive side of the business, as was explained earlier, will also add incremental margin to that. Yeah. Although we should also add the fact that our search for long-term contracts that are in resilient markets, such as the ones we won with Fidelis, they have a value in of their own, but they are at lower margin. So we're compromising a little bit, but we are making up for it with the two actions on ladders free and on React. Brilliant, thank you. Okay, so the next two are actually two that I think I should answer, but please feel free to comment if you have anything to add, guys. The first one, it says there's been an unusually large number of shares traded recently. They appear to have been sales. Are you able to comment on whether you know who has been selling, as there hasn't been any holdings RNSs disclosed to the market? Well, there was a TR1 recently. Jason and Justin Korenik, when we acquired the business, it was at a tortuous time in the market. We were negotiating in April and obviously made the acquisition in May. And this is immediately preceding the invasion by Russia in Ukraine and all sorts of things going on. We were fortunate enough to have some great investors that backed that acquisition. But clearly it was a tough time. And Justin and Jason offered under certain conditions that instead of taking £500,000 worth of shares, they would take an additional £500,000. In other words, £1 million in total. But that they would like the ability to be able to convert that back to cash in a relatively short period of time. So as per the announcement about the deal, Jason and Justin took £1 million worth of shares, half of which had a hard lock-in for just 6 months, and then an orderly market for a further 12. And it is that first tranche that has since been sold in the market. Now, they haven't been sells; they've been buys actually. They were bid for their shares through an orderly market, through our broker Singers, by an institution, and we do know who it is, but it's not. We're not. It's not for us to actually say. It hasn't tripped them in terms of needing to issue another TR1, but I can safely say to you that there's an institution that was actively buying those shares, and that's an explanation. Any of the other share trades that have gone on, we're unaware of. They're certainly not institutions that we're aware of, and they certainly haven't tripped up any other TR1 statements. I suspect, therefore, they're probably just a combination of retail trading. I hope that answers the question for everybody. The second question that I'm going to answer is the share price of the company has continued to disappoint despite the good news flow that has been given to the market. Has the company thought about how it can reverse this trend? Clearly, in being on the listed market, we're always aware of our share price, and clearly we want to see it go up rather than go down. What we do have is for a company of our size, a very unusually high quality of institutional investors, and there are a couple more underneath the need to recognise that they're there, that we are aware of. But if you just look at the share register of those people that hold over 3%, you'll see some good quality names. These people are all very supportive and very strong holders, and we're constantly in touch with them, as we are indeed with the retail market. We put out news when it's real, and when it's there, we don't put any anything out that doesn't meet the standard. And we obviously make ourselves available through this platform and the platform that's available to us via Mello. So I think we've done what we can. I think it's really down to be frank, individual retail investors. That's where the activity takes place. What we as a management team can do is focus on the fundamentals. We've taken this business from 5 years ago or 4 years ago, revenues of about 3.5 million and losing about £600,000 a year, to now this last year, obviously nearly 14 million of revenue, £1 million of profit, and we actually have 2/3 of our business is cash generative. So we just got to focus on the fundamentals, and I believe that as people take notice of those fundamentals, I hope that maybe some of the day trading will be alleviated, and people will buy the shares and hold them for their long-term value. So that, I hope, answers that one. I'm now going to move into the questions that have been asked during the session. So Mark G has asked a question. It says, the contract reactive and ad hoc segments both achieved record half-year revenues in 2022 H2. However, this came at a high cost, with gross margins in both cases falling below half their normal level, and both making sizable losses after admin expenses. What has gone wrong in these segments, and what are you doing to fix it? I think some of the conclusions drawn in that question aren't actually correct. Basically, I think we have explained that for the tail end of 21 and going into 22, the market, due to both COVID and post-COVID, brought about a number of challenges there. I think that, again, maybe I should pass it to you, Sean, but for us, that business is very much the sharp end of our spear, isn't it? We get a lot of traction with customers in terms of breaking in, because we're very, very good at what we do, seen as consultative. And then it's a matter of landing and expanding. How would you answer that question?
Yeah, I think you've handled it well. I think, look, at the end of the day, the services that we do in that segment is how we get our foot in the door. We can react very quickly. The standards are very strong. Anything to do with cleaning, we can do. I think we're very unique in that proposition. Our clients appreciate and respect what we bring to the table, and that often, through the sales and marketing activity, increases the cut through with that customer. It increases revenue, increases margin. So, yeah, I think you answered it fine.
Great.
Shall I also just chip in as well, Mark, to add something extra to that? Yeah. So the segmental analysis in the annual report, the line that is shown as operating profit, that includes all acquisition related costs and tax in that figure. We as a business much more focus on our EBITDA, because for us that represents the underlying trading of the business, separate to other M&A activities. So I think maybe that's what Mark G is referring to, and I hope that explains it.
Brilliant.
Our adjusted EBITDA, taking out the acquisition activity, is the figure of £1 million, and that's the one that we're focused on.
Good. That's great. Thank you very much, both of you. Okay, moving on. A quick question from Michael H. How is the pest control business going? It's not a core business of ours. We may tag it in as something like subcontract into an overall contract, Sean, but it's not a core business of ours yet, is it?
Yeah, I don't know whether this is harking back to before our time, Mark and Andrea. So we did have the environmental business, which I think pest was part of that. So since we all got involved in the business, all three of us, we stripped things back. We had a focus that was mile wide, inch deep, and now it's the converse. So Mark's quite right. Pest control, we never really go after pest control opportunities. If it's an add-on and we get asked to look at it through a customer, then yeah, we'll certainly add it in if the revenue and the margin's correct. but it would be subcontracted out. It's not something that we do ourselves just yet.
Brilliant. Thank you. David O, you are now up to 83% recurring revenues as a proportion of turnover, significantly higher than 3 years ago, following acquisitions of Fidelis and Ladders Free. Do you envisage this proportion rising above 90%? Not sure, are we?
Well,
I mean, look, we've go on, Andrew. You take a stab at it first, and I'll come.
Well, I was just going to say, but by nature, our reactive and ad hoc are slightly unpredictable, and I think we're not setting ourselves that target of 90%. With it's risen above 85%. We think it'll stay in those high 80s. I think that's what we can predict right now, but we haven't really contemplated over 90%.
Anything to add, Sean?
No, spot on.
Yeah, absolutely agree. Yeah, no. So look, we now have that resilience in the business of 80, 85 percent recurring revenues, and as you say, anything that's reactive is a bonus. Right, there's two questions that are very similar, so I'm going to read them both. One's from David O. It says, does the high gross margin from Ladders Free result in the group returning to the high gross profit margins pre-Fidelis? So that's one element. And I would add that it's not just the Ladders Free, but it is also more of the higher margin reactive piece coming through. And then Peter D says, what time frame do you have for returning gross margins to high? Hang on a sec. Sorry. I basically think it's towards the 30%, as mentioned in the presentation. So, for instance, do you think this will take 3 years or less? And I'm inclined to hope that it's going to take a lot less.
I'll take that one, Mark. So yeah, look, Ladders Free, as we said in the presentation, high margin. We've said that the reactive services have come back online. So the answer to the question is yes, we do see it increasing up to around about 30%, and we aim for that to be in this financial year. Not take any longer than that.
Good, brilliant. Okay, right. I'm just wondering if I should keep doing this in order. Actually, try and go to some others. Hang on a second. One for you, Andrea, but I wouldn't mind giving a starting point for the answer. It's from Paul L. I think I recognise who Paul L is, and I'm sure you do as well, Andrea. Thank you, Paul. You're a good, supportive shareholder, I believe. But you ask a very reasonable question that's out there. What's the underperformance / disappointment driving Fidelis goodwill write-down? Now, I'd like to give you a thematic answer, and Andrew can give you a more precise one. I really had hoped that we'd flagged that this was coming in presentations we'd given before when we acquired Fidelis and since. To wind the clock back, you will recall that we paid overall just over £2 million for the business based on its current trading 12 months trading, and that there was an earn-out put there. But because of the tax advantages to the sellers, the cap on what we would pay was set at a very high level. It was set at them increasing the profit, in fact, more than doubling their profit to £1 million, and therefore the cap on the purchase price after the earn-out was set at £4.75 million. And we've said every time I think we've been on air that we have no reason to believe we'll get anywhere near that level of performance in Fidelis. It is going well. It did go well, but there was no way that we were ever going to pay based on the business achieving £1 million of EBITDA. And if it did, then we'd be delighted to do so. The answer is that it grew its EBITDA by less than 100 grand in the earn-out period. More since, I'm pleased to say, because as we've added revenue and grown the business, it's continued to grow. But as a result, the earn-out was £350,000 instead of a a maximum of 2.3 million. And obviously that has spilt over into, well, there's goodwill in the balance sheet that suggests you're going to pay a lot more. We haven't paid a lot more. We've got the benefit of not paying a lot more in terms of both cash and outgoings. But you have to square the circle with, a relevant impairment. So that's my non-accounting way of describing what's going on. Is there anything more you can do to clarify?
Oh, you've explained that really well, Mark, as a non-accountant. So yes, just to say the goodwill was calculated at the point of acquisition. I suppose a year ago, we could have considered if that goodwill, if we were still confident in that goodwill, but the earn-out period still had 6 months to go. So it seemed the right thing to do to leave that figure in, that maximum figure in at that point. Now we're at the end of the earn-out period. We know exactly what we're going to pay for the business. And in terms of, there's been growth since we've acquired it. We're definitely anticipating more growth from that business. But I suppose that more growth isn't starting from the EBITDA figure of £1 million. It's starting from a lower figure. So that's why it seemed prudent to write down the goodwill to anticipate the future growth, starting with the point we're at now.
Brilliant, thank you. Hopefully that's answered the question for you. Right, so Peter D, another question. Admin expenses. I'm not sure this is accurate either, but you'll know better. Admin expenses have grown substantially in full year 22, mainly I suspect because of Letters Free. I don't think that's the reason. But do you expect further increases in expenses given senior hires mentioned and wage inflation? Yeah, we did make the senior hires, didn't we? We made them in mid sort of 2022, but that's part of our investment to grow. So any comment on answering that one, Andrea?
Yeah, so I think comparing year on year, remember that the FY21 just had 6 months worth of Fidelis in there. So now there are 12 months. So that's an impact. Also, as well as when we do the acquisitions, as well as the goodwill, we also have an intangible asset, which is the future value of the contracts in place that we value according to the IFRS rules. Those customer list assets get amortized. So this time last year, we had 6 months of Fidelis amortization in those admin figures. This year, we've got 12 months and 4 months of Letters Free amortization of the same intangible asset. So those are non-cash accounting costs, but they are in the admin costs. I'll also add that the impairment write-off of just over 500,000 relating to Fidelis was also in those admin costs.
Brilliant. Thank you, Andrea. Sometimes it confuses me as well, but no, I understand. I understand. Hopefully everybody else does. So hopefully that answers the question. Peter, right, just quickly going on. Malcolm R, are there any opportunities to improve Fidelis's margin? Now, when we answer this one, can we please try? I just want to make sure that we don't provide any commercially sensitive information for competitors of my business or customers or whatever. Yeah. So, are there any opportunities to improve Fidelis's margin, Joel?
I think it's an easy answer for me, actually. We are looking at, for the Fidelis business, opportunities with slightly higher margins. There was a tendency in the past to partner with some of the consultants in the education sector, and the margins were typically quite low. So I'll caveat that by saying slightly, but obviously it's something that we're looking at the moment.
Okay, brilliant. I'm just going to go through today's. So I'm just reading some of these just to see if I can pull some together. One from Graham R here. It says, how many chargeable colleagues are you targeting to recruit a year over the next few years for organic revenue growth, please? Now, Sean, we talked about this recently, actually, and I'd like to start by giving a sort of an overview question, but you might want to come in and answer it. So this is just to remind everybody, this is how many chargeable colleagues or how many sales resources, marketing resources, or whatever else resources we need to maintain the level of organic revenue growth or accelerate it. Right now, over the last several months, we've been focusing our engine on growth, and we've got some great stories and some great wins, most of which we're not able to announce because they're of a modest size and scale. But that's where the organic growth comes from. I think last year's organic growth actually was great, considering the market was not as good as we could have performed had we not been tied up as a relatively small team in 2 acquisitions. We only did 1, and a fundraise. So I think that we've got the capacity and the team and the scalability, especially in marketing, because of the relationship with the likes of CRM Squad, to scale accordingly. However, we've been running hard for the last 6 months, 7 months, and I think where we are right now is we actually need to sit down and build out a much more detailed strategy on our growth, because we see the potential as being enormous, and we do need to consider whether adding some more resources would increase the pace even further. But we also have to take into account the capacity of our ability to deliver the business that we run. So there's work to be done, I think, is what I'm trying to say. Tactically, we're focused on selling every day of the week, so we're not holding back. But at the same time, we probably do need to lift ourselves out of the business for a few days and map out something a bit more strategically focused that we can invest behind. Do you want to add anything to that? Sure.
Only that, it's something that all 3 of us have discussed, and with Sam here, with our group sales director, we are due to get together in a room, all 4 of us, and just map this out properly. I think Mark's quite right. We've been running full pelt at this for some time now, and Mark mentioned it earlier on in the week that he's managed to get some blue sky thinking time, whereas Andrew and myself and Sam are in the day-to-day grind, many hours of the day. So we just need to get that session planned, sit down, refocus, map it out, and then take it from there.
Yeah. So the answer to the question is we can't tell you how many people we might add right now, but when we do, we will. And what I can say to you is the return on investment is usually really quick. If you look at how quickly we've managed to scale things with, Sam joining us and Chris Ryan joining us, it's been, their impact was within 2 or 3 months, wasn't it?
It was, yeah.
Yeah. Okay, so question from Paul: discuss relative lack of operational leverage to the big revenue jump in full year 22. Does this change going forward? I mean, there are a lot of questions here, Paul. So just to discuss it, look, the challenge was for a good part of last year, the reactive business was not profitable. But we weren't about to throw away because it's been so good to the business, and also it has what's got us through the door with some very, very sizable blue chip customers and FMs. That business is coming back now, and so we do see that changing moving forward. And we have made a superb acquisition of a fantastic business and fantastic people, and that's what we're now going to leverage going forward. I think we should be looking forward rather than behind, as I think your question implies. And the answer to that is yes. And there are forecasts out in the market. It's not for me to repeat them, obviously, but there are forecasts out in the market which demonstrate that quite clearly. Simon T is just out. Apologies, Simon. I'm more happy to take this offline. But look, the question is just being asked: could we not have persuaded Jason and Justin to hold on to their shares a bit longer. That wasn't part of the agreement at the end of the day, and I'm hoping that people will have seen when we announced the deal that, you know, surely, you know, you'd understand why a certain number of shares were set aside for a shorter period of being held than others. They were, you know, this is their lifetime's work. They're very, very keen to stay involved with the business. They've got £500,000 worth of shares between them in the company for some time to come, and they're active with us on growing out what we've got here. You know, it's not for us to say what they should convert into cash and what they shouldn't. What I would say to you is the deal as it was originally agreed in early part of last year was that it would be just £500,000 worth of shares. And so it was their help that managed to get the deal across the line. So I think that's as much as we can say on that particular question, Simon, if you don't mind. Paul L, segmental reporting shows each revenue vertical is loss-making, and on a simplistic basis, it seems that growth accentuates loss. How is this different from looking forward? I think we've just talked about operational leverage and the challenges that we were given to us in the reactive business. I think that's part of the problem. I think, Andrew, you've talked about the write-offs or the, not the write-offs, sorry, the amortization, you know, how that impacts. So I think that it's different looking forward, especially as we accelerate further. It doesn't accentuate loss. It actually, you know, brings about more profit. And obviously we also have a, you know, Ladders Free and Fidelis are both cash generative businesses. The only one that is cash consumptive at any point is the React business, and the React business is only about 4 million of the total, and getting therefore smaller as a proportion. So I don't know if you want to add anything to that, Andrea. I think we've already answered it, haven't we?
I think we have already answered it. I think you know, I have to report the operating profit that's defined, and you know, we might prefer to report on EBITDA, but you know, we report the operating profit line that we need to report. So that's you know, and it's got a lot of one-off and extra things in there this time that, you know, are in the notes as well.
Yeah, agreed. We got two last questions, and I'm going to have to answer them both, I think. But by all means, add anything if you can. So the first one is, and there was somebody else that asked this question. Yeah, David O asked it, and so does Mark J. And effectively it is, are you thinking of making any more acquisitions? And a slight different flavour of the other one is, you know, in which areas would you look to acquire? So right now, we think that what we have as a group is both unique and has huge potential. Very fragmented market in which we have a fraction of that market. We have a fantastic value proposition which we think we can sell, and we are selling, and demonstrated some of the wins we've had since acquiring Ladders Free. And the prospect universe is huge for us. And by the way, we are one of the largest, if not the largest, that look like we do in terms of consolidating these specialist services into one platform and making them available to the whole of the UK. So our focus right now is organic growth. That's what we're gearing up for. We have a great sales team, great methodology, and we just want to accelerate that. So that's our focus. All the time in the background, you know, somebody like me that's not as close as the other guys to the grindstone will look at potential opportunities, but we're not that active at the moment. We have professional help from BDO, so we are always looking on the outlook. I think in terms of where would we purchase next, I think now it's about filling any minor gaps that we might otherwise subcontract to. So for example, waste management is a good margin area. It's a good business. And we use waste management companies, so we might acquire in there, but we don't see it as being essential to our strategy right now. We think the strategy for adding value is through, and rapidly, is through leveraging what we have and delivering very strong organic growth in both revenues and profits. Anything to add to that, guys?
No, nothing from me.
No.
Brilliant. Thank you. And then the last one, from Mark G. You actively market your business to retail investors. We I wouldn't say market. I think we make ourselves available and we're as transparent as possible. But
Sorry,
your
Mark.
brokers,
Oh, we just lost you there for a second. Could you just repeat the first part of the question? Thank you.
certainly. It says you actively market your business to retail investors, but your broker, Singer Capital Markets, does not make its research available to retail investors, whilst many of their competitors do. Maybe you should change brokers. There's more reasons than one for having a broker. Research is important, but it's not the only important feature. Their research is available, certainly the front page is available more widely. And I do know a number of retail investors that have access to it, and they often share it with other people. And it's Singer's business model, effectively. The quality of their research, they would suggest, is so good that people should buy it. But that's not for me to comment on. They have been an exceptional broker through this phase of our growth, as indeed were Allenby before that in terms of that particular phase. So I don't think we're inclined to change. What I can do is say to you that we have appointed Equity Development, who will be doing their own initiation and research. Now, I appreciate that sometimes that can be looked at equally as skeptically, but at the end of the day, it is our way of providing pseudo-independent research to you without you having to get hold of the full broker note. And I hope that will help you some more. And we will make ourselves increasingly available and increasingly transparent. And I hope that will help you.
Mark,
that is the last of the
Sean.
questions. Sorry,
Thank
Alex.
you. Sorry, Mark, Sean, Andrea, that's great. Thank you for that. And I believe you have addressed all the questions that came in from investors today. So thank you for being so generous with your time. But Sean, perhaps before redirecting investors to provide you with their feedback, which I know is particularly important to you and the company, could I please ask you for a few closing comments?
Yeah, thank you. Look, I just want to thank everyone for taking the time today to join us on this platform once again. And for those of you who are shareholders, thanks for your continued support. I hope you find it useful. And if you've got any questions, you can always contact us offline as some of you have done in the past. Thank you.
Perfect. Sean, Andrea, and Mark, thank you once again for updating investors today. Could I please ask investors not to close this session, as you will now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, and I am sure will be greatly valued by the company. On behalf of the management team of React Group PLC, we would like to thank you for attending today's presentation. That concludes today's session. Good afternoon to you all.
Thank you, Alex. Bye-bye.
Thank you.